Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, the news that moves those markets. And before we dive into those markets and the news, let's pass it over to Eric, who has one great comment from last week from a guy who probably should be joining our team here.
That's right, Miles. This one comes from Counter Crow, who's got some great insight in the stuff that we talk about each week. He always has some good input for us. But after Tori's comments last week about platinum not really moving based on geopolitical events, Counter Crow stated this: "Marvel at the beast, which is rhodium, up $250 in a day. Is this not a record? This argument that industrial metals aren't relevant in geopolitics is void. In fact, in a time of a hot or cold war, industrial metals derived from only two countries become extremely valuable, more valuable than monetary metals."
First of all, let me start by saying that he is right. Geopolitics can absolutely move industrial metals, especially when you're limited in your mining source. So we talked about platinum, coming out of South Africa and Russia almost predominantly or almost exclusively. So when you have sanctions and you want retaliation coming from one of those countries, certainly one of the things they could do is limit, the exporting of platinum, for example, and it would absolutely, because of geopolitical pressures, cause a spike in the price of platinum. What I'm talking about is it's not going to respond like gold does as a monetary metal. So we see gold oftentimes respond to geopolitics because of trade concerns, because of economic concerns, and those all are stimulated oftentimes by geopolitical tensions, pressures, and backroom dealings. So I apologize for that coming across the wrong way. The rhodium topic is separate altogether. There, I personally believe, yes, you can still see some restrictions on export and that sort of thing, but more importantly, that's probably more speculation in a particular market with a rare metal.
Let's move on to some of the fundamentals that are taking place this week. We've got a lot to cover in a short amount of time. I want to go back to Tori again. We're going to kind of blast Tori today because also last week, when we were talking about the European Central Bank's decision, Tori, you had mentioned that at least the U.S. has room to go down on interest rates, right? We didn't. Obviously, we saw that today. The Fed released their statement. We're recording on Wednesday, but let's talk about what Draghi did and the European Central Bank's decision earlier this week.
Well, he hasn't done anything yet. All he's done is try to move the markets with, the words, the power, the influence that he yields, just like any central banker does or any highly ranking political officer does. We've seen it from President Trump in the last couple of days as well. We've seen it from Jerome Powell today. He didn't do anything other than say, look, we can do something. So what I meant by not being able to have any room to lower interest rates any further, if you have an economic crisis, let's say, Draghi comes out last week and says, we can lower interest rates further. We can get into more negative territory and we can continue to quantitative ease. Well, that's great, but you've been quantitative easing and you still need more, right? You've been at 0 to negative quarter point on lending rate, and you need to cut rates further. How much further can you go? At least we have, before we get to 0, we've got 2.25 points to play with, is what I was talking about. Really disappointing to see Draghi do this, and it didn't go unnoticed, obviously, by President Trump. He really fired back.
That's right. And Miles, as we've seen these leaders, these political figures, their words can have a lot of, impact in the markets. And what did you see from the euro after these comments from Draghi?
Well, the euro's actually up, which obviously we would consider to some extent surprising. I think there's some charting reasons why that could take place. I mean, the euro's just been a sawtooth pattern going down for a year now. I mean, we're down 11.5% since January 18. We're down 3.5% already this year. So from a charting perspective, you could argue anytime you have that type of volatility, you're going to have some bounces on news, especially when you have some RSI divergence on the EXY, the Euro index. So to come out and not say much of anything, to come out and say we're keeping options on the table, following this type of pretty consistent downward pattern in the euro. It doesn't surprise me to see it pop up short term over the last week or two. I think the trend is still down. I think the euro continues to fall. I think the dollar is still the stronger currency. The European markets certainly second that, and some of the European credit issues are much more dramatic to the European markets than our credit issues here domestically have yet become.
Yeah, the euro is really not that volatile. We're up a little bit here in the short term, but in this range, we've seen a low of $1.11 for the euro, and we've seen a high of $1.13. Today, we're sitting at $1.12, right smack in the middle. So we've seen those two, but over the course of the last year, you've seen a high of about $1.17 and a low of $1.11. Downward trend for sure, but it's not like we're seeing a lot of wind in the sails of the euro. Trump is upset because he wants a level playing field. He's saying, look, they weaken their currency and we aren't. They're taking measures to weaken the euro for the sake of the trade benefit, the employment benefit, what it does for economic drivers, and he's upset about it. And I understand that, but at the same time, cutting rates is not good, right? It might be good for what? For borrowing. I guess you're driving a credit-driven economy with cutting rates, but you're not helping people get a return on their investment. It's a negative sign from an economic barometer standpoint. And quite frankly, yeah, it's good from the trade impact. It's good if it weakens the dollar on the world scene, which Trump is saying it's too strong. He's been calling for 18 months now for a weaker dollar. He's not getting it. And he's frustrated. And he's taking shots at Draghi. He's taking shots at Powell. He's threatening, what, Eric, you said yesterday, he's threatening to demote Powell.
Yeah, Trump yesterday was asked, if he's going to demote Powell, and his answer was, we'll wait and see what he does. Well, now we know. The Fed left rates unchanged today. Been a lot of movement since then. Miles, take us into what gold's doing.
Well, gold hits the highest price since April of 2018. We're looking back up in the 1350s. We've been talking about this declining pennant for a very long time. We exceeded our February highs from earlier this year. We're testing the old highs from last year. And those highs from this year came on the heels of a 20% Dow correction. So what's really moving the gold price right now is my question. And I would argue reality. Maybe reality is finally starting to set in. Maybe the average investor around the world, we certainly know the institutional investor has been involved because gold hits all-time highs in 70-some currencies this year. But maybe the average investor is starting to play as well. So I'm cautiously optimistic. I know from a charting perspective, we still have some noise to get through. I mean, we've got to breach the June 2016 high at 1375. We've got March 2014 at 1393. A few months prior to that, August 2013, 1420, and then there's like nothing between 1400 and 2000. So we have to get through some of gold's longer-term declining highs. But this is a heck of a sign. I don't want to call it a breakout yet because we've come into this range. We've played around for a while, and we've gone right back down to the bottom of the range too. So 1220 is not off the table yet. But we see 1375, we see 1390, we see 1400. We come back down and hold and start moving back up higher. Yeah, we're talking breakout at that point.
And with this move today, as we record right now, gold's sitting at about 1361, up 1.04%. Silver kind of followed suit today as well, up 1.14%, which is about 17 cents on the day. Right now sitting at 1523. Miles, is this enough of a move in silver to change your outlook on it?
Well, it's doing the same thing gold's doing, just slightly behind. So when the price plays catch up, obviously the snapback's going to be a lot stronger, and we'll say the same thing here in a second when we mention platinum. But silver is up about 6% over the last 3 weeks. The thing I do like about silver is it came down to try to retest that declining trend line, but it didn't get down there. We were unable to push below those November 2018 lows. So we've been taking this step down pattern in silver, just like where we were talking about the euro here a minute ago. But this most recent move came down, bounced above that previous low. Now, that doesn't necessarily mean that we're seeing a trend change, but it certainly is a good thing to plan for. We've got some short-term pricing in the 15s on silver, but honestly, because of all this noise over the last year or two, I need to see $20 silver before I'm arguing for a breakout on that side too.
The 1510 market, I did a little webinar on this the other day, and you had brought this up, Miles, technically, that we've seen a lot of support and resistance at that 1510, 1511. And so I am excited to see where that goes, but I'm not going to buy a silver breakout until it starts outperforming gold. That ratio is still 89.5.
Ratio-wise.
Yeah.
Right.
Yeah, that ratio is still 89.5. So whatever gold has done, silver's sort of attached at the hip there. when that ratio starts dropping down into the low 80s, then I'll personally believe that silver's kind of unchained and we're looking at some inflationary concerns and a real silver breakout.
I mentioned the similarity in platinum. It did come down to its floor, but the difference is platinum's floor is rising while silver's had been falling. But like clockwork, came right back down to the floor, bounced 2.5% up. We hit that 382 fib on the last move. So if platinum continues up, we're probably going to find a little bit of short-term resistance. 830, 845 is where I see my next little short-term trading range between here and there. But same story. We start seeing breakouts in one metal. One breakout begets another. Gold moves, silver moves, plays catch up. Silver starts outperforming gold. Platinum moves, plays catch up, probably starts outperforming everything. So that brings us over to palladium, which continues to currently outperform everything. Palladium obviously has bounced pretty hard. Volatility, it's not surprising to see that move up. It dropped 20% in a month. A 10% rise is not crazy by any means. Tests around 1,500, 1,550, and then obviously the old-time high at 1,580. But I think this brings us back to what Tori started talking about, and that is the concept of ratios. I have noticed in the comments from time to time over the last few months when we're touting platinum, we've had a few people bring up the idea that, palladium is this monster, underutilized giant in the rare earth metals. There's no reason for its price to crash. So I'd like to just come out and say, when we're talking about ratios, we're not talking about palladium necessarily getting cut off at the knees. What we're talking about is as some of these other metals start to move, their percentage gains against the others exceeds.
Kind of just like Tori was speaking about.
Exactly.
You'll believe silver's breakout when it outpaces
exactly.
gold. You're looking for the same thing from platinum with palladium.
So, because I look in the mirror and I say, hey, what's more likely? Platinum going to 60% of its all-time high, or palladium going to twice its all-time high? Because that's the type of percentage move we're looking at here. Platinum goes up to 1,600, it's doubled in price. Palladium has to go to 3,200 to get the same type of percentage return.
Yeah, and first it has to break through those previous, highs that you've been talking about. If it doesn't go exceed the 1,580, the palladium doesn't, well, then I'm not going to believe that breakout either. Like you're saying,
Right.
We're going to erase some of that, and we're probably going to set a lower high, right? Which
just like the Dow did.
Indicator.
Just like the Dow did earlier this year.
Yep.
And Tori, let's go back to the Fed real quick. He made some comments today. We know that he left rates unchanged, but as I like to do frequently, here's an article I saw today from Reuters. The headline was this: Wall Street climbs after Fed signals potential rate cuts. And so here we go again.
Yeah, they also signal potential rate rises and potential rate nothings all in the same speech.
That's right. And we saw this, they already used this a few weeks ago with the negative jobs news. That didn't affect the markets, and it actually was a positive impact on the market because that meant that this rate cut was coming. Well, that was supposed to be today, and it did not happen. So now, because of these dovish comments, there's the potential for another rate cut. So the market can kind of lift up. What's going on?
Well, that's sort of the key. What you just said is the dovish comments. That they accompany the lack of news in terms of a rate cut or rate hike, right? And that's to control the fallout, if you will, or to minimize the selling. Because like you said, when they were talking about it, the markets rallied, right? Well, because they didn't cut rates, they don't want the markets to decline sharply. So they just say, not now, but soon. Not now, but soon, right? So as long as they do that, they can control the fallout from that type of a decision. But Draghi, the words, again, we mentioned this, but the power of the words, look at what his comments did to the European economy, not just the little euro bounce that Miles described, but here we have Deutsche Bank even rally now to about 7.17. We're back over 17 a share because they'll quantitative ease, they'll cut rates further, and that he'll step in and do everything he can to try to save that bank. But it's not saving two of their big-time New York dealers that are leaving Deutsche Bank because they really do feel as if that's a failing entity. And so all eyes, again, we said that that's probably a July event. I'm not convinced that we're going to see it here in the next week or two, but at some point in the summer, it will be tested, and we'll see the European Central Bank coming to some form of rescue of Deutsche Bank and maybe Santander. the interesting thing really to me about the whole central bank intervention is there's supposed to be a total separation between the politics and monetary policy of the central bank, and we're not seeing that right now. Trump is firing at Powell. He's threatening to demote him and that sort of thing. But we saw Bernanke kowtow to Obama in 2012. There's sort of an unwritten rule that you don't manipulate rates or intervene in any form in the economy in the 6 months leading up to an election. And I think that, Trump is making a dangerous enemy if he continues this sort of rhetoric with the central bank chairman in Powell. And, quite honestly, Draghi is going to have some impact here on the elections in Britain and what we see playing out there.
Yeah, but sometimes you have no choice, right? I mean, we look back at the Lehman issue back in 2008, and that was during an election. In fact, to the point where the candidates postponed their campaigns, and they met with President Bush and Nancy Pelosi and others at the White House. So sometimes you have no option. I mean, the markets are going to do what they're going to do, and you have to react accordingly. Nobody wants the markets to move aggressively during an election. Wrong person gets elected, right?
Right.
I mean, the people that the New York Times and the Washington Post and Wall Street doesn't want to get elected might actually end up winning if you have some type of crisis.
Well, and if you're Trump, you're hanging your hat on this. Your whole reelection is based on this positive market and this positive economy, which means that he's not going to let up on Powell anytime soon. He needs this to happen. He needs the market to continue to go up because that's his reputation on the line. It's his next 4 years on the line.
Well, that's a great point. And then he always has somebody to blame, right? If the market does turn down, he can point the finger at the Fed. Yeah, but all of this is moot anyway because Facebook is coming to the rescue with their new cryptocurrency. So the whole world monetary and economic scene is going to change. We're good.
Well, doesn't this get back to why we do what we do in the first place? I mean, it's the same argument. Right? I mean, it's this inability to allow markets to breathe naturally. It started 100 years ago with the Keynesian economic system. Just this permanent need to juice the markets to get the results that you want, to tell the political story that you think your constituents want to hear. And Keynesian economic was there to juice the markets when they're bad and pull back when they're good. And when was the last time they pulled anything back? They juice the markets when they're bad. They juice the markets when they're even. They juice the markets when they're good. And it's all about the election game, and it's all about...
Well, driving the credit-driven economy,
yeah,
too.
Exactly.
Right? I mean, and that's what we're really seeing is that there's a great article, Miles, The Fed Can't Save Us by John Rubino. Greg Hunter posted it on usawatchdog.com. And, Rubino says the next recession's overdue because this is the longest expansion on record. All right, we've touched on that here in the show, but loading up car buyers with subprime loans, student debt, government debt, corporate debt, all at record levels. And they've all borrowed more money than they've ever had in history, right? And so this is something that is building. And this goes to Steve Hankey's comment on the McIlvaney Weekly Commentary. Every hyperinflationary event is driven by government debt and spending. So all of this Fed intervention, all this stuff, it's all about driving me and you to borrow and spend. And that's how the economy is broken, right? They can sit here and kick the can down the road all they want, but the Federal Reserve can't save us. Ultimately, there's a day of reckoning. That is why you own gold.
Well, they can. They're just never going to employ the tools that they need to long-term save us. It brings us back to what Eric said at the beginning of the show. Isn't it a bad thing? Why are markets going up with interest rates going down? It makes no sense. Well, in 1988, that made sense. If it costs you 16% to buy a house and then it costs you 14% to buy a house, that's not a bad thing. But running on the longest, we're now talking, a decade and a half since the Greenspan era, where we've been in this minuscule interest rate environment. So, yeah, interest rates going down just to try to juice the market, to continue to build off the leveraged credit system. And you wonder why we believe in real assets.
That's right, Miles. And those are all the reasons that you do want to own gold. But even if you look outside of gold as a safe haven asset right now, if you're a value investor, I don't know that there's a more undervalued asset class in the market right now.
In the words of the great Howard Onstadt, the cycle itself still remains, and commodities will again have their day.
I agree with Eric. Best undervalued asset class.
That's going to do it for this week. We're excited to see what the next week brings as far as prices go and where we close. Thanks for listening.
You can find us on Twitter at ICA Gold, Facebook, McIlvaney Financial, or our website, mcilvaney.com. As always, if you like what you heard, click the subscribe button, ring the bell. Do join us in the comments if you have anything you want to bring up, a piece of insight or a question. And give us a call if you'd like to discuss your personal portfolio with one of us or one of the advisors here at McIlvaney ICA. 1-800-525-9556.
Have a great week.